Imagine this. You get home from your 9 to 5, and instead of just crashing on the couch, you tap into the world's largest financial market. What if you could turn your evening hours into a real financial opportunity? Well, today we're going to break down exactly how you can do that, and the best part is, you don't have to quit your day job. You know that feeling, right? Your job pays the bills, which is fantastic, but it feels like those bigger financial goals are always, well, kind of just out of reach. But what if the key to unlocking them wasn't in working harder, but in the hours after you've already clocked out? Okay, let's talk scale. We're looking at the Forex market here, a financial behemoth where over $7.5 trillion are traded every single day. But honestly, its incredible size isn't even the biggest advantage for us. The real secret weapon? This market never really sleeps. And here's where it all clicks into place for us. See, while our local stock market shuts down for the day at 3:30 p.m., the global Forex market is just getting warmed up. For a lot of people, that's a problem. But for you, the 9 to 5 professional, this is your main event. Your evening is prime time. So let's dig into exactly why your evening is the golden hour for trading currencies from India. It really just comes down to a simple matter of global timing. So the Forex market basically rolls across the globe through 4 major sessions, starting in Sydney and ending in New York. But the real magic moment for us, it happens right at the end of that chain, after 5:30 p.m. our time. This is what's called the overlap. It's when London and New York, the 2 biggest financial centers on the planet, are both open for business. This is your golden hour. And this right here is exactly why that overlap is so important. When those 2 giants are awake at the same time, a massive amount of trading volume gets pumped into the market. It creates more energy, more volatility, and, you guessed it, the kind of big, juicy price moves that traders are looking for. It's when the market is truly alive and kicking. But okay, hold on. Before we even dream about placing a trade, we have to talk about the most critical thing of all, trading safely and legally. Getting this part wrong, well, it can be absolutely devastating. And this isn't just a hypothetical warning. This is a real story from a seasoned trader. People have lost their life savings not because they made a bad call in the market, but because they used some sketchy, unauthorized app that got their bank accounts completely frozen. That is just not a risk worth taking, ever. So here's the bottom line, your non-negotiable checklist for staying safe. You absolutely must use brokers that are authorized by the RBI. Or even better, just trade currency futures legally right through your official Indian demat account. Seriously, this isn't just a friendly suggestion. It is the only way you can build a trading career that's sustainable and, most importantly, legal. Okay, with this super important safety stuff covered, let's get into the fun part. We're going to dive into the 2 fundamental concepts you absolutely need to know to read the market and actually place a trade. All right, first up is something called a pip. It's basically the smallest little tick of movement you'll see in a currency's price. Think of it like a single point in a game. Every time the price moves up or down, we're counting that movement in pips. It's how we keep score of our profits or our losses. Next up, we have lot size. Now, if a pip tells us how far the price moved, the lot size tells us how much money we have riding on that move. It's the volume of your trade. And this is so crucial because the lot size is what determines what each of those little pip movements is actually worth in real money. And this is where it all comes together. When you take a tiny 1 pip move and you combine it with a standard lot size, the effect gets magnified. So for example, a single pip in your favor can mean a $10 gain. Now, just imagine that happening in that volatile evening session, when the market can swing 50 or even 100 pips. You can see how the numbers can start to get very interesting very quickly. So now for the really exciting part. We're not just going to be guessing where the market's going. We're going to use a very specific strategy that's designed to spot where the big players, the banks, the institutions, the smart money, are making their moves. The key here is to look for something called a fair value gap, or FVG. As you can see, this specific 3-candle pattern is kind of like a footprint left behind in the market by the big financial institutions. It's a clear signal of an imbalance, a spot where they moved the price so fast they literally left some of their orders behind. It's a clue. And the strategy itself is actually pretty straightforward. First, you spot one of these gaps on your chart during that evening session. Second, you just wait patiently for the price to circle back and revisit that area. And third, you watch for a clear reaction from the market, and that's your signal to enter the trade. See, it's a method based on pure observation, not on guesswork. And this number right here, this shows you the potential. Using this exact setup, traders have been able to catch moves of over 500 pips on things like gold, sometimes in just a matter of minutes. That's the power of learning how to trade in line with where the big money is flowing. But, and this is a huge but, even the greatest strategy on earth is completely worthless without professional risk management. This right here, this is what separates the people who trade for a living from the gamblers who always, eventually, blow up their accounts. Meet the 1% shield. It's simple, and it's absolutely non-negotiable. You should never, ever risk more than 1 to 2% of your entire trading capital on any single trade. This rule ensures that even if you hit a losing streak, you're not wiped out. Your number 1 job, always, is to protect your capital. You know, this all boils down to one simple word: discipline. If a trade doesn't go your way and it hits your preset stop loss, you have to just accept that small loss and close your laptop. You walk away. There is no such thing as revenge trading to try and win it all back. That discipline, that is the true mark of a professional. And that brings us to our final, and maybe the most important piece of this whole puzzle: adopting the right mindset. You need to think like a part-time professional if you want long-term success. Look, your goal here is not to get rich by next Tuesday. It's to build a skill. So start on a demo account where there's no real money at risk. Focus on making good, consistent decisions, not on how much money you made or lost on any given day. And remember, you have a day job. That's your superpower. The pressure is off. You have time to learn, to grow, and to get this right. So when you put it all together, the right strategy, a professional approach to risk, and a patient mindset, the hours after you clock out from work could hold way more potential than you ever thought possible. The market's open. The only real question left is, are you ready to explore it?